Hi, good morning clients and trading reps. Thanks for tuning in to our webinar this week. This week we're going to have a sector update on Singapore REITs. So we're going to touch on the 10 most commonly asked questions investors might have when investing in REITs now. And then following that, we'll have a sector strategy update for October. And then we'll have an update for the Phillip 20 portfolio as well. So to start off, I will touch on the sector update for Singapore REITs. We know that this year, for the first 9 months, we have seen S-REITs return at 14% year to date, and this makes it the 6th best performing sector for this year. And a lot of investors would be having questions at this moment as to what is the outlook going forward for S-REITs. Is it still safe to invest in S-REITs given that the interest rate hike momentum is gaining strength? So we touch on some commonly asked questions. And these are the 10 questions that I'll be touching on in a while. So first off, we start off with, I think this will be the topmost question on every investor's mind, and that is the impact of US rate hikes on REITs and whether in such a climate is it still safe to buy REITs. So I think if we take a step back and look at the rate hikes in perspective, we see that now what is happening is that Fed is hiking rates, and this is in response to better economic data and not so much of supply side driven inflation like we saw in the late 1970s, early 1980s. That kind of stagflation scenario is what we don't want to see. But right now, we are definitely not in that kind of scenario. We are seeing interest rate hikes, and that is in conjunction with economic data coming out better all across the world. You see economic data improving in US, in Europe, in across the world, Japan as well. So I think rate hikes in response to better economic data is something that we wouldn't fear as much as compared to if it's a rate hike driven by supply side driven inflation. So we look back in history and then we look at the last rate hike cycle that happened in 2004 to 2006, and we can see that in that period of time, if you look at the chart with me on the right, from 04 to 06, S-REITs actually did manage to perform, and not just perform, they did perform spectacularly well as well. A CAGR return of 26% during that 3 years, despite the steep hike in interest rates. You can see from the blue line here. Blue line is the Fed funds target rate, red line is the 3-month SOR rate that most loans that the REITs take up are pegged to. So that 3 years you see huge spikes in interest rates, but yet the S-REITs still managed to perform very decently in that 3 years. So what we think now is that despite interest rates going up, what is more important is that whether rents are able to go up accordingly during this rate hike cycle to offset the negative impact of interest rate hikes. You get an impact such as like higher financing costs on the REITs, etc. So the next graph I'm going to show you tells us exactly that. You see that in across most of the 4 sectors from 04 to 06, there was actually strong momentum in the rents, and so this strong momentum in the growth in the office rents, shop rents, hotel RevPARs, etc. These actually help to mitigate the impact of rate hikes on REITs. So second question is that apart from higher financing costs, what other ways do higher interest rates affect REITs? We see that increases in interest rates can occur at different ends of the yield curve. We have on one hand the short end of the curve, and on the other hand the long end of the curve. So if you are looking at interest rates increases in the long-term interest rates, that will actually decrease the appeal of REITs as an asset class. So if you look at this graph with me, the blue line is actually the Singapore 10-year bond yield. And if you look at the instances where we had sharp spikes in this bond yields, you see that a lot of times the yield spread actually are supposed to compress by a similar magnitude. So we often use the 10-year bond yield as the default, as the risk-free rate that we use to measure REITs, and the yield spread is actually the difference in the trading yield of REITs, the difference between that yield and the 10-year bond yield. So if the blue line increases, that is the risk-free rate increases, the yield spread should compress. And you see that a lot of times in these sharp spiked instances, the increase in the 10-year bond yield actually does not correspond to a similar magnitude in compression of the yield spreads, and that actually tells us that in theory, on paper, on the ground, REITs prices are actually correcting more during this period, so that the yield spread is actually maintaining. That means the REITs prices are dropping, so that the yields are going up, such that the yield spread is maintained at a pretty high, at a higher margin than it should be. That means the compression is not as steep as the increase in magnitude in the 10-year bond yield. So increase in long-term interest rates, if in very layman terms, that actually increases the attractiveness of fund flows into these long-term bond yields, and potentially that could decrease the appeal of REITs as an asset class. So that's how the whole system is like. And on the financing front, if we look at since 2015 until now, we've seen 3 rate hikes, and we have seen rise in the SAW rate as well. SAW is, as I mentioned, the interest rate that most REITs loans are pegged to. So, but what is limiting the upside in borrowing costs for REITs now is that the landscape amongst banks is very competitive. We see that not only just in REITs, we see that in the property fund as well. A lot of you guys who are active investors in the property market, you must have seen the kind of mortgages packages that the loans are pushing out, even lower than the rates that you can get 2 years ago, despite interest rates rising. So that demonstrates the competitive landscape amongst banks now. And in the S-REIT space, from our channel checks on the grounds, conversations with the managements, we found that the same is happening on the ground as well. For a lot of these loans, despite the SAW rate going up a little bit over the past 2 years, you see that the bank spreads are actually tightening. So how much the REITs are paying on their loans is a function of the SAW rate, the SAW plus a bank spread. So the SAW might be going up, but the bank spread is compressing. So this tightening bank spreads actually helps to limit the upside in the borrowing costs for REITs. And a third point to note that is helping the REITs is that so far we've seen the Sing dollar strength keeping the rise in the SAW in check. So you see a relatively muted rise in the SAW over the last 2 years, despite the numerous rate hikes by the Fed. So this Sing dollar strength keeping the rise in the SAW in check is actually helping the cap the borrowing costs for REITs as well. Third question, I think that is that is a question that is linked to question 1 that we have touched on. In question 1, we say that what is more important is that rents can go up during this cycle for REITs for the REITs to increase their rental income so as to offset the negative impact of interest rate hikes. So then, what is the outlook for each REIT sector? The generic view is that apart from retail, if you look across the other sectors, most of them are facing tapering supply after a peak or a surge in supply in this year. And we believe that the easing supply post 2017, this should actually build a base for rental rates to climb. So first of all, you look at retail. Retail is in a bit of retail headwinds. There are quite a bit of headwinds right now, not just the e-commerce and the entry of Amazon into Singapore. You see that over the next 2 years, we've touched on this in our Capital Land Mall Trust initiation as well. quite a bit of supply coming up, especially in the eastern part of Singapore. You have Jewel, you have Paya Lebar Centre, etc. So the blue bars actually represent the net annual supply over the next few years. And you can see that these are actually quite a bit higher than the average demand over the last 5 years. The green line is the average demand over the last 5 years. And the blue bars is over the next 2 years is actually still a bit higher than the average demand over the last 5 years. But do note that we feel that the average demand is kind of like can be quite supply driven as well. So if you look at the retail space index, rental index, and the occupancy, given all these challenges, we do expect, as we mentioned in the initiation report, we expect retail sales to stabilize by second half of this year and rebound. But rents, there will be a lag factor, and occupancy as well. We expect these two to bottom only sometime in 2018. Next up, we look at office supply. This year is the notorious year for office REITs. Peak supply, everybody has been talking about it. Marina 1, Dual, but so far on the ground from what we heard, take-up rate has been pretty healthy. For Marina 1 is as high as 70% pre-committed. So after this year, you see that supply will taper off, and this tapering off is actually a lot lower than the average demand over the last 10 years. And if you track the office rents index, you see that actually these rents are showing signs of stabilization. We expect office rents to rebound this year. For industrial REITs, for industrial supply, we are seeing the same scenario as well. Supply is pretty high this year, but will taper off after this year. And the good news is that industrial activities, they are picking up. And for industrial rents, we expect them to bottom by or before end of 2018. Okay, lastly, we have hotel supply. That is a very similar situation. This year, we have quite a bit of supply. We have 4% of total stock in the whole of this year. But after this year, you see that annual supply is just a little bit more than 1% increase every year for the next 2 years after 2017. And the bright spot for hotels is that the hotel RevPARs, they're actually showing signs of stabilization over the past half a year. If you look at the latest reading for hotel RevPARs, they're actually near a 2-year high. So yeah, for a complete list of the hotel openings, the malls, the offices openings over the next few years, do take a look at our full report where we have the complete list of all these buildings opening over the next few years. So next question will be, how does S-REITs compare with regional REITs at current valuation? An interesting thing to note is that despite the 14% return year to date in the first 9 months this year, at the absolute spread or absolute yield, of S-REITs of 5.9%, this is actually the highest even if you compare across the other major REITs markets. You compare against Australia, against US, Hong Kong, Japan, none of the absolute yields are actually as high as what S-REITs are trading at. And in terms of yield spread, and that is the difference between the absolute yield and the risk-free rate, S-REITs are trading at 3.8%, not the highest, but then you look at the highest is Hong Kong, second highest is Japan, 3.9. We are actually not too far off. But do note that for Hong Kong, the data is actually from 2012, where the latest available data is shown. But for the rest of the REITs, their data compiled is actually the average post-GFC, and that is from 2010 to current. So a brief summary of the regional REITs valuations. Historically, as REITs, you look at the spread, 3.8%, that is very close to what you're seeing across the 7 years post-GFC from 2010 to now. Average is 3.7, now we're doing 3.8, so very close. Australian REITs, the valuation is actually at the +1 standard deviation mark. Average is 1.8, and now they're doing about 2.3. So likewise for US REITs, only Hong Kong REITs, as you can see, as the red line on the bottom chart shows, the average yield spread is about 4.8. Right now they are doing about 4.1. And for Tokyo REITs, J REITs, same story as most of the other REITs. Yield spread slightly above the post-GFC average. So we compared the current valuation of S REITs versus the regional REITs. How about historically, comparison of the current valuation versus the past 7 years historical? You see that in the red line shown, the current yield spread, as we have touched on, 3.8 is actually very close to the average spread that we have seen over the last 7 years. So next question is that book value, is it a good way to judge if a REIT is over or undervalued? I think it is useful to compare book value, but not just across the REIT's own historical levels, but also across the industries. And if you compare across industries, then preferably you do that against similar size REITs, because if you look at big cap REITs, for example Mapletree, they tend the average price to NAV post GFC will be about 1.2 plus, and big cap REITs typically they trade at higher valuations than smaller REITs. Some of the reasons include the economies of scale and the fact that a lot of these big cap REITs they're able to get cheaper financing, and cheaper financing would mean that it is much easier for them to do accretive acquisitions. So then it would be important for investors to assess market conditions to judge if the discount or the premium to NAV is warranted. Next question we have is that now we see that growth in global economies is accelerating. Wouldn't investors be better off looking at growth stocks instead of stable stocks like REITs, like telcos, like utilities? So unlike telcos or utilities where you have your phone bills or you have your electricity bills, these fees and these tariffs, they are more highly regulated necessities. REITs are actually exposed to commercial rents and prices, which are more market driven, based on demand and supply. So despite being traditionally viewed as stable income, very passive income kind of investment, like bond-like kind of investments, REITs are actually able to give investors a growth upside in terms of being able to capture the upside in rents as well in an improving economy, and yet at the same time still committing to pay out at least 90% of the rental income as dividends. So you have this stable passive income play, and yet at the same time with exposure to upside growth in the economy as well. Next we have the question of, if you look at REITs, whether a REIT with a larger portfolio of freehold properties, is it better than a REIT with a portfolio of shorter leasehold properties? I think the thing to note is that if you look at valuations, if you look at a REIT that holds a freehold property versus another one that holds a shorter leasehold property, the freehold one will actually typically trade at a lower cap rate. Cap rate in layman terms would just mean rental yield, and so the freehold property trading at a lower cap rate would just mean that valuations for the same amount of rent, valuations are higher, and so then that the NAV of the REIT would then have priced in the freehold factor. Then to compare across the REITs, you would then be looking at a discount to the NAV or the premium to NAV and a comparison across the sectors as the next consideration. So because a lot of investors view REITs as bond-like instruments, and we know that in bonds there's this metric called the duration that measures the sensitivity of the bond price with with changes in fluctuations in interest rates. So a commonly asked question that we get is also, how do we compare if we want to calculate something like this for REITs, the duration for REITs, the sensitivity of the price to fluctuation in interest rates? How do we go about doing it? Firstly, REITs, because they do not have fixed maturities like bonds, and then there are many other factors involved in the variations in the REIT prices with fluctuation in interest rates as well, because that will depend on various factors as well, including the amount of gearing that the REIT is on, the amount of debt that they have hedged on fixed rates as well. So all these factors come into play, so it's not as straightforward to measure such a metric, but what investors can take note of is the sensitivity of the REIT's earnings, not the price but the earnings, to fluctuations in interest rates or forex movements. And these sensitivities are usually available in the annual report if you do a Control F under sensitivity analysis. So last question I have is, right now if you were to invest in REITs, what are the key risks for you? So I think what we've seen so far is that economic growth has been moderate, improving, and coupled with low inflation. So that is able to accommodate monetary policies that are very market friendly. And this kind of environment actually is very conducive for REITs as well. So going forward, if we were to see accelerating inflation, that could actually lead to faster than expected rate hikes or tightening by the Fed. And so any sharp upturn in inflation, I think that is the key risk for REITs right now. So I'll leave you with a chart that shows the REIT universe for all the individual REITs that we cover, including information on the debt of the REIT, the amount of fixed debt, amount of debt that is expiring in this financial year, next financial year as well. So I will end off with a look at what is happening on the ground in physical property transactions. This year we saw a lot of buoyancy in residential, as all of you can see from all the en bloc transactions going on. I think that buoyancy is not just in the residential market. You see a lot of that in the other sectors of physical properties as well, in office, in retail, in hotels as well. You see that this year, Capital Land Commercial, they divested 2 properties. These 2 properties were divested at valuations, at cap rates, that is rental yield, close to 3%. Valuations were way above the last valuation that is the REIT is holding these properties on the book at. The premium to the last valuation that the building was sold at was as high as 30% to 40% over the last valuation price. And then you look at Jurong Point, this year was sold at 2.2 billion, and that actually works out to a net yield of 4.2% based on the sale price. 4.2% cap rate, that is actually quite a bit lower than if you look at a comparable suburban mall. You look at Tampines Mall under CMT, cap rate for that mall is close to low 5%. So CMT is holding Tampines Mall at 5% cap rate, but Jurong Point got sold at a 4% cap rate. Beach Road as well, this year GoCoLand, the bid is the highest we've seen in the history of Singapore for an office site, GLS. And I think that reflects the buoyancy for hotel markets as well. You saw an article last week in Business Times in the uptick in the demand for hotel properties as well. So with that, I'll pass on to Paul to touch on the October strategy update.
Hi, thanks, To Hong. I'll just move on to our monthly report. No change in our target. I'll move on to the macro section. Just on the first point, I think the focus right now it's on the so-called Trump trade and the tax cuts that he has proposed. We think that the chances are fairly good because there's a midterm elections next year, and politicians, that's what they do best, in cutting taxes, I guess. For us, more importantly, will be the impact on interest rates. We think that it gives the Federal Reserve cover to raise rates, especially in December. And worth noting that prior to this, in the most recent September Fed meeting, there were already, if you look at the so-called dot plots, there were already the 3 rate hikes banded around the dot plots. So there was already expectation of 3 rate hikes, and this was before the tax cuts. So with the upcoming tax cuts, this only raises the likelihood of further interest rate hikes in the 2018. Going back into Singapore, if you look at the Singapore macro situation, the external environment is very buoyant. We saw the PMIs at 3-year highs. The electronics PMI was even higher at 7-year highs, and also exports is riding on a 6-year high trend growth rates. The next bullet point is on the MAS monetary policy statement on the 13th. I guess most likely the neutral stance will be maintained by the MAS. What everyone is looking for is more on the extended period, whether they intend to maintain the neutral stance on the Singapore dollar. The reason why neutral stance, most of the forecasts, even though economic growth is probably on the upside, but if you look at core inflation, is within their 1 to 2% of expectations. And more important is the job environment. 2010 to 2014, we used to trend about 120,000 jobs, but last year it collapsed back to 16,000 new jobs. And I think the data we got for the first 2 quarters was a negative 14,000. So the jobs environment is still very sluggish in Singapore, and that's the reason why very likely that the MAS will keep their neutral stance. Despite the upside in the economy due to the external environment. I'll move on to the next section, which is our stock calls. Basically, no major change. We are buying sustainable yield. These are like your Asian Pay TV, CCT, and so forth. Property. We now finally be beginning to see the property moving into the small to mid cap stocks. I guess the one fundamental behind the move towards small to mid cap property stocks is that they are more purely focused on the Singapore market, and of course they still have their large 30 to 40% discount to RNEVs. The other sector would be banyan tree, as we mentioned many times before, coal, and also on micromechanics. The most recent semiconductor data saw that the semiconductor sales are up about 24%. These growth rates are 7-year high growth rates. And more importantly, it sets up a very strong September quarter, not only for micromechanics, but I guess for the most of the electronic stocks. Worth noting that 24% growth is a huge number, because semiconductor is almost 400 billion per year industry. And finally, the other buy call is dairy farm, which we initiated recently. Basically, we are expecting this large cap the growth to resume, supported by margin expansion. In terms of the last section is sector updates. Basically, we monitor several high-frequency data points that we get. The domestic retail is still soft, but we think that the strong external environment will percolate into a stronger domestic demand in the next few quarters. The other interesting data point we got was that we saw construction projects awarded saw a big spike recently. In our data points, and also with the recent change in the less focus on pricing for public sector contracts, which will actually be, I guess, supportive for the sector at the margin at least. Materials bottoming, I'm referring more on the RMC sector. We're beginning to see the demand. If you read the report, demand has been on the negative for the last 24 months, but we're beginning to see some stabilization. The next bullet point is on hospitality. The tourist numbers begin to weaken back again in the July data, in the August data. Sorry, in the July data. But more important, we see the RevPAR, like Teh Hong mentioned, is back to 2-year high. So that's more positive for the whole hospitality sector. Property, we mentioned this before, that the sales remain buoyant. We are on track for the best sales in 5 years. In terms of the hospital, the data that we see right now is that while the August saw some improvement, as you can see from the slide, the year-to-date hospital admissions private hospital admissions only grew 2%. This is far off the pace that they enjoyed in 2016, where private hospital admissions was up 10%. Finally, on our sector updates, that everything sets up well for the banking sector. The banking sector will enjoy a triple headwind, we believe. On the background, we have rising rates. Then we will see strong loans growth, especially with the amount of property being sold or launched that's coming up. And finally, with the vibrant capital markets, this will be supportive for the wealth management products as their clients begin to take on more risk. That's it for me on the strategy update. Yeah, I will move on to just a 1-minute video before we move on to the technical. Just a video for those who missed out on our reasons for calling a buy on micromechanics.
Hi guys, and yeah, now to the last segment of today's webinar. This is Jeremy speaking. So for the last segment, we just give a brief update on what happened in September, mainly in the Singapore's market, as well as what happened to the Phillip 20 portfolio. So first of all, just take a quick look in the STI, what happened in September. So basically in September, STI was down around 1.75%, mainly due to, again, the headwinds from North Korea and US. And you can see over here from the chart, the previous update that we gave was some sort of a bearish call with the main emphasis on this 3195 support area. But probably just run through the chart again from the start of September and follow through the annotation from point 1 to point 3. So as you can see over here, point number 1 I want to highlight over here is some further sign of weakness was being highlighted by the 20-day moving average crossing below the 60-day moving average shown by this particular arrow over here. So 20-day moving average being shown by the red line and 60-day moving average being shown by the blue line. So in the early part of September, what we saw was this particular bearish signal came into the market, and then you can see subsequently once that happened, STI continued to dwindle lower. But ultimately, we sort of warned about this strong support of this 3195 area, which has been holding price up since May of this year. You can see multiple rejections of this particular range low of 3195 since May, June, and July each period. and ultimately more recently in September last month. And as you can see, after the STI retested this 3195 support area, what happened was that the uptrend was being kept intact again by this strong support at 3195, and ultimately the STM managed to rebound off this particular 3195 range low. So the September loss of 1.75% has been totally erased right now in October. So beginning since the start of October, you can see STI started to spike up sharply. And what I want to highlight over here is this point number 3 over here was that this was the last Friday's price action. So what we saw over here from last Friday was STI did actually broke above this range of 3274 range high. And what it's telling us that the uptrend might be ready to re-establish itself again after this particular bullish break of this 3274 range high, which I've highlighted over here, where price was ranging back and forth between this 3274 and 3195 area. So based on last Friday's price action with this bullish break above this 3274, there's a high chance that we might see the STI retest this July high of 3354. But ultimately, in the near term, probably price action wise for the STI, it will be pretty much range bound within this 3354 area to this 3195 support area. And another important thing to note is right now, this is today's bar over here based on 9:30's price. But what we want to point out over here is to see further bullish follow through from last Friday's close, and to make sure that this isn't a really false breakout. And if this turns out to be a false breakout, it might actually be quite a bearish signal. And what I mean by that is if this turns to be a false breakout, and if the STI actually does close back below this 3274 immediate range high, a bearish kind of formation is building up if that happens. And what I mean by that is you can see if this particular breakout turns out to be a false breakout, some sort of a head and shoulder pattern will be forming, and this being a left shoulder, this being a head, and this will being the right shoulder. So continue to look out for further developments within the STI, and we'll keep you up to date if there is any changes to the kind of a bullish sentiment that we are seeing right now. And with that, we'll move on to what happened to the Phillip 20 portfolio. So in the month of September, there were only 2 trades that were being closed, mainly Moya Asia. We closed that out with a negative 1.71% loss, mainly due to the bearish price action. And since we closed out this position, Moya has been pretty much moving in a sideways motion, flat since then. Another trade that we closed out was Mandarin Oriental. This was a pretty quick trade. We entered in 6 September and we exited in 19 September again due to bearish price action, but we managed to garner a pretty good gain of 28.92% within a short time span. And on average, the realized gain from these 2 trades, we managed to rack in 1.36% for the month of September. And moving on, in September, even with the sluggish price action from the STI, we managed to find 3 new entries over here for the Phillip 20 portfolio, namely in Jumbo, Singapore, ONG, as well as SPH. So to highlight again, these 3 trades are slightly different from the rest of the trades that we have in the Phillip 20 portfolio, and these 3 trades are mainly based on the methodology of more of a bottom picking kind of a trade, whereas the majority of the trade within the Phillip 20 portfolio is more of a trend following kind of a deep buying trade. So over here right now you can see this is as of last Friday's close. I think we need more time for these 3 trades to work out the current bottom that is sort of forming right now, and we'll continue to monitor these 3 trades moving forward. And in terms of our watch list wise trades that we are currently watching very closely, here's a watch list that we are seeing that are all moving in a certain uptrend. And if you put a chart up for all these counters over here, it probably resembles a pretty much kind of an uptrend, strong motion over there. And what we want to capture over here for trades over here is to catch the dips, to reposition ourselves back into the uptrend for the trades within this watch list. And yeah, ultimately, here's the current portfolio of the Phillip 20 portfolio as of last Friday, 5th October. And just to re-emphasize again, the Phillip 20 portfolio is purely based on technical analysis and no FA involved over here. So like I mentioned again, most of the trades within the Phillip 20 portfolio are based on trend trading kind of a methodology whereby we try to catch the dips to enter back into the uptrend. And as you can see over here, as of last Friday, the average unrealized gain was at 4.92%. And the cumulative return since inception, realized plus unrealized, stands at 11.45%. And just to highlight again, each trade have a weightage of around 5%, and the Phillip 30 portfolio sort of strive to achieve a portfolio of 20 stocks in terms of our ideal position sizing. And yeah, with that, we have come to the end of today's webinar. We'll pause right now for Q&A if there's any questions. Thanks.
Hi, good morning. This is Richard here. There's a few questions on Mapletree Industrial Trust regarding their update to their strategy. So just to clarify, their strategy change is to include data centers outside of Singapore. They already data center is already within their investment mandate, but that's only within Singapore. So the only change is that it's just expanding this mandate for data centers outside of Singapore. However, the trust will still be very Singapore centric because this overseas data center is capped to a maximum of 20% of their portfolio. There's another question about whether it will set up competition with Capital DC REIT. The short answer is a yes, but the market is so big, Ray, just having one more competitor is not really going to make much of a difference. And there's also so many other competitors popping up all the time. So I think that this is just irrelevant to worry about with reference to Capital DC REIT. Also, there's another question about what sort of incremental DPU can we expect from the move into data center assets overseas. That's entirely dependent on the speed of their acquisition of new data centers.
Hi, Jeremy speaking here. So there's a question asking, we have Miyoshi within our portfolio. Is there any reason for selecting this stock and what is our take profit? So I think, again, probably for those that haven't been following us, one good way to follow us is through stocksbnb.com, and we actually update our reports on this particular website. And for instance, our update on Miyoshi was actually being placed on stocksbnb.com, and just by clicking onto the different tabs over here, we have Technical Pulse, which is my segment over here, which shows all of the daily trading ideas based on technical perspective, as well as the Phillip 20 portfolio. All the trades are updated over here with all the relevant explanations, as well as entry price, stop loss, and take profit. So for instance, the most recent report, which was the monthly review over here, it could be downloaded from stocksbnb.com, as well as all the trades are being hyperlinked within the table. So for example, Miyoshi over here was dated back entry at 23rd August. Simply by just clicking onto the link, we bring into the tab of the reason why we actually entered into Miyoshi. So sorry for the link.
Hi guys, Teh Hong here again. We give Jeremy some time to sort out that Miyoshi issue. So I will answer another question on CCT first. The question is on the rights issue for CCT with the recent acquisition of Asia Square. We did publish a report on that acquisition dated 22nd September. You can refer to that report. But basically, our call is that we would advise investors to subscribe to the rights, because on the surface, if you look at it, it looks like a dilutive acquisition. But the other things to look into is that even though it's dilutive at the start, we believe that there's a lot of upside potential for the building, because first of all, if you look at capital recycling for CCT, they sold 1 George Street, they sold Wiki Edge this year. These two buildings were sold at cap rates of 3.2 to 3.4%. Now you're using the same capital to recycle into another building, and you're getting 3.6%. And not to mention that the new building you're getting is the remaining land tenure of that building, Asia Square, is 89 years versus the divested building's remaining tenure is longer. 89 years is longer. And then secondly, if you look at Asia Square, the target to be acquired, right now occupancy is 89%. The with the network of tenants that CCT have, we have no doubt that you will see occupancy creep up under CCT, because if you look at the average occupancy of their portfolio, the average occupancy is actually a very healthy 97%. So any upside from the current 89% in occupancy, that will actually give you an upside in rental incomes as well. And then if you look at the acquisition price, about 2,700 PSF. If you compare the acquisition price with the neighboring offices, if you look at One Raffles Quay, if you look at MBFC's, average valuation there is about 2,900, and versus what CCT is paying 2,700, and Asia Square's land tenure remaining is no shorter, or is in fact longer than the remaining land tenures of all these competitor buildings that I just mentioned. So all in all, I think it's a good acquisition. So we would advise to subscribe to the rights. For more information, you can refer to our September 22nd report that is available on our Stocks BNB.
Sorry for the delay just now for the technical question. So someone was asking about the Miyoshi and the rationale behind it. Again, there was some hyperlink errors over here, and bring you back to the original report that we came out for the Miyoshi technical pulse report. So as you can see over here, on a daily basis, we actually do provide some trading ideas, and we think if they are good enough, we actually will sort of place them within the Phillip 20 portfolio. So this is an example of the technical pulse report that we generate, and this is the rationale behind why we enter into Miyoshi, and everything is being linked up to existing updates. So for instance, this was the most recent update on Miyoshi in 5th October, and the previous update was on 23rd August, and you can actually click on this to go to the previous report with the rationale behind it. So we started sort of watching Miyoshi back around in 23rd August. So this was the first piece that we actually sort of have a buy idea on Miyoshi based on technical perspective. So the initial idea was that Miyoshi has been moving very strongly in this particular uptrend, and what we noticed was a strong base building up around this long-term 50% Fibonacci retracement level, as well as this 63 to 65 East support area. And what prompted us to sort of come out with this trading buy note was the bullish break with increasing volume on this particular day on 23rd August. And then I think subsequently since then, prices continue to dwindle lower without much bullish follow through. And as of 5th October, we sort of saw some bullish momentum coming back into Miyoshi again. So same thing again, fast forward 1 month later in October, same kind of a base still holding up around this long-term 50% FIB, as well as this 63 63 and 65 cents support area over here, which held out again. And the bullish sign that sort of came in again recently in 5th October was this surging volume bullish break above this immediate range high of 7.5 4 cent price. So with the relevant rationale, we actually did a write out on this, but the main idea behind this is strong support that's been holding up around this 50% FIB level over here. So again, for just normal following, we have actually relevant entry price, stop loss, as well as take profit over here. And this take profit is for those that just want to have a rough guide of where prices might actually be heading to. But for the rest of our trades for the Phillip 20 portfolio, at the end of each technical pulse report, we'll have the updated P&L for the Phillip 20 portfolio. We actually leave the take profit level out because chances are a lot of these trend following trades actually do move very strongly in the uptrend, and we try not to place a take profit target over there so that we manage to let the winners ride further into the uptrend, and hence we leave up the take profit level over here. But for those who just want to have a quick guide in terms of some resistance level to use as a guide for take profit, we actually do provide them within the technical pulse report over here, stated clearly at this for Miyoshi is at around 8.6 cents over here, which is based on this particular resistance that has been formed back in around April to May-ish period.
Hi guys, Hong here again. We have a question on property stocks. The question is that given the recent bull run in the discounters, are they too expensive to buy for further upside gains? I think the important thing to note is that despite all this rally, I think we saw in the returns table, real estate is one of the highest performers this year. But despite this rally, a lot of them, especially the small cap stocks, they have not moved much. The small cap developer space, for instance, what we have under our coverage, Chip Eng Sing. Chip Eng Sing, our target price of 90 cents is actually a 50% discount to RNAV. And judging from the recent en bloc bid prices, you see a lot of those property counters which have run. For instance, last Friday, UOL is the current land bids are just those developers with land banks, such as UOL, such as Chip Eng Sing, such as CDL. All these counters under our coverage, they will stand to gain the most, especially if the land bank has been bought quite a while back. For instance, UOL has this Amber Road plot that they bought earlier in the year, or was it late last year? They bought it before this whole buoyancy came in. Their cost price is about 1,000 PSF. In Amber Road, the same vicinity as what you saw last week, the CDL paid for the Amber Park en bloc. That one, the cost price is 1,005, and both are freehold in the same vicinity. I think they're just a 5 minutes walk away. So you see that the kind of new bids on the ground, they are actually very bullish for developers with existing land bank, with prices that they've paid for a while back. So if you look at that piece of land, 1,000 PSF land cost versus the latest 1,005. So if you forecast like a break even for UL at about 1,005, that is just what CDL is paying for the land cost. And then I think for that piece of land, if UOL were to get a 20% margin, 30% margin, I think based on current land bids, actually it would not be too far-fetched to say. So I think the summary of my points is that despite the rally, a lot of discounters are still trading at deep discounts to their RNAV. Like I re-emphasize again, for example, Chip Eng Sing, 90 cents target price, still a distance from current price, and it is a steep 50% off RNAV for our forecast. And our methodology is that for the big cap stocks, we have a 15% discount, and for smaller cap, we usually have a bigger discount to RNAV.
Hi, Jeremy speaking here again. There's a question asking how do I keep track of the Phillip 20 portfolio buy sell ideas. So again, I'll just refer everyone to stocksbnb.com, where our research reports are all being uploaded to. So for technical pulse wise, it can be found at this top tab, technical pulse, and on a daily basis we upload new trading ideas based on the current ongoing sentiment. So for example, these are all the trading ideas that we have on page 1 and so on and so forth. So for example, if you want to know more, just click onto it, and I think all the relevant details will just pop out in terms of entry price, stop loss, and take profit, as well as some relevant figures over here with support and resistance and the explanations, and most up-to-date view on the Phillip 20 portfolio with the gain and loss, as well as the past trades and the past realized performance money review report can be found in the bottom tab as well. So someone is asking about the when was the inception date for this particular portfolio. So we sort of came out with this portfolio back in around May-ish period, but the initial setup of the first 20 trade was picked up based on our previous technical pulse report with different dates involved in them. So in terms of finding one real date for the inception, we can't really pinpoint to one exact date. But if we were to use a definition or a cutoff date, probably May would be one to look out for. So yeah, this is the current P&L that we are actually counting since May.
Hi guys, I think that is about all the questions we have for today. Thanks for tuning in today, and we look forward to seeing you guys again next Monday. See you, bye.